Alright guys, big news out of Thailand. We are hearing that Thailand does want to start taxing foreigners and tax residents in general of Thailand on their foreign sourced income. So this has been a big topic online. There's a lot of different interpretations and different opinions and commentary going on, a lot of speculation about how exactly this will affect people. Foreigners in particular are very concerned about this. We were going to wait until further clarification was put out by the Thai government, but because it is such a hot topic and a lot of people are very interested and frankly concerned about how this might affect them, we thought we should weigh in and give our opinion on it. So in this video, we're going to talk a little bit about what we know so far at recording date, which is the 28th of September. We're going to talk about the things that we would like further clarification on and the things that we are keeping our eye on with this new set of rules to tax foreigners on their foreign sourced income. So the idea of this is the rule will apply to tax residents of Thailand. So that doesn't mean a resident in the physical sense. If you're living there, if you're residing there, that doesn't mean you're necessarily a tax resident. To be a tax resident of Thailand, there are factors that come into it, but generally, if you're living in Thailand for at least 180 days in the calendar year, you could well be regarded as a tax resident. And before we get on into the rest of this video, I will just say, if you do want more up-to-date, more timely information updates about what's going on in Thailand and other parts of Asia, I'd encourage you to head over and follow us on Twitter and also Facebook, where we put out alerts on what's generally going on in the region in a more timely basis. So the first point I'm going to touch on here is from an article from the Bangkok Post, where they said that anyone with a double tax agreement, a tax treaty with Thailand, will be exempt from this new tax. Now, I would just say to treat that with caution and to, rather than take that as a blanket statement that anyone who has a double tax agreement with Thailand will be exempt, I would encourage you to actually look at the double tax agreement or hire a professional who can look at your double tax agreement with Thailand and have a look through that and see how it affects you. If you like, we can assist in that. Now, the reason why I say that, and other people have spoken about this, Integrity Legal and others, double taxation agreements are not always the same. Every two countries, when they negotiate a double tax agreement, it's a negotiation. So the terms are set by the people negotiating the agreement. So it can be different from country to country. So that's why I would recommend talking to someone who is familiar with double taxation agreements and working out if this taxation will affect you. For example, tax treaties will have different articles or different kind of subsections attached to them, and there will be different treatment for different kinds of income. So it could be job income, business income, investment income, rental income, pension income. All of these things can be treated differently. It is true that many DTAs have a carve out for pension income, which states that the contracting state, which is your country that pays you the pension, will be the country that gets to tax you on your pension if they tax you at all, and not the state that you may be living in, residing in as a tax resident such as Thailand. But not necessarily always the case, so be careful there. And not only just looking at the terms of the agreement, if there is not a dispute, but if two countries both regard you as a tax resident, say your home country and Thailand, then you also need to look at the tiebreaker rules, and that will tell you which country ultimately gets to treat you as a tax resident. So as an example, the US tax treaty with Thailand and the Australian tax treaty of Thailand has a carve out for pensions, saying that pensions will only be taxable in the contracting state, which is the state that is paying out the pension, your home country. But just be very careful there. Talk to a tax accountant or to a tax attorney to help you know how it's going to affect your situation. The next point we're going to talk about, which is very important, is it has been a bit vague when this was announced whether this will apply to all income or whether this will apply to remitted income only. So reading from the Bangkok Post here again, it says, the principle of tax is that you must pay tax on income you earn from abroad, no matter how you earn it, and regardless of the tax year in which the money was earned. So when they're talking about the tax year here, this is referring to a previous rule, the current rule, where if you didn't remit income from abroad into Thailand in the same year that it was earned, it was generally tax-free. So this is saying here, regardless of the year that it's earned, it's going to be taxable. But the other thing it says, and this is where I definitely would like some clarification, where it says you must pay tax on income you earn from abroad, no matter how you earn it and regardless of the tax year. it has no mention there of whether it's remitted or not. It actually starts to sound a little bit like a residency-based tax system where all income from abroad is taxed if you're a tax resident. Now that would be a massive development for Thailand, and it would frankly send shockwaves through the expat community and have some major ramifications that would, actually really would make people want to look to other locations like Malaysia and the Philippines. So we definitely need some clarification on that point. I have seen differing interpretations on this. Some people saying that the tax will apply to all income earned anywhere at any time. That was a quote that came out of the finance department. And also that it will only apply to remitted income, which would bring it more into line with the changes that are coming to Malaysia in 2026. I was comforted to see an interpretation out of KPMG Thailand, one of the big four accounting consultancy firms, saying that it will apply to remitted income. Saying, and quoting here, the new interpretation means that foreign sourced income brought into Thailand from 1st of January 2024 onwards will be subject to Thai income individual tax regardless of the tax year in which the income was derived. So regardless of the tax year thing, we're pretty clear on that. This is saying here that it is money brought into Thailand, so that sounds to me like it is money that is remitted into Thailand. So if this is the case and the read on this is correct, I would say that money that is not brought into Thailand might not be taxable. But we really need to wait and see and get some further clarification on that. Another point that we'll bring up here, which is quite a big one, is that people are concerned that even if it does relate to remitted income only, and talking about money earned in any tax year, how will that affect money that is brought into the country to purchase a condo? Because anyone who's bought a condo will know that when you bring money, or when you want to buy a condo as a foreigner in Thailand, you have to get a certificate saying that money has come from abroad. So if you're bringing a chunk of money, which, yeah, it is capital, but if they're saying that the new tax rule relate to income earned in any year, capital would have been income at some point in time. So that money had to come from somewhere, and it would have come from income at some point, most likely. So if it was interpreted as income when it's coming into the country, and then you're bringing in $100,000, $200,000, $300,000 to buy a condo, and you then have to pay tax on that, well, that's going to kill the condo market. No one's going to want to do that. People are definitely going to start looking at other options if they want to buy real estate in Asia. I would be surprised if they did want to start taxing money brought in, lump sums brought in to pay for condos, but we really need to wait and see if they have more to say on that. So wrapping it up here, guys, this is a very fluid situation. Don't take any of this as gospel at this point. This is just our read on it at this point. It is subject to change. We will bring you further updates as they come to hand. You might get more timely updates in our Twitter channel, in our Facebook channel, so follow us over there if you're interested in that. But just to canvass the main points again, we would like for more clarification from the tax department in Thailand to know whether this will relate to all income or just remitted income into Thailand only. At least if it is remitted income only, that's not going to be a huge thing, providing it doesn't affect money brought in for condos. If it's just remitted income, not remitted capital, that's still something you can tax plan around, so it's not the end of the world. If it is all income from all sources, essentially a residency-based system, that's going to have a massive impact on the expat market in Thailand, and people will be looking to go elsewhere. So we'll have to have a look at that. Maybe they'll be saved by DTA, maybe they won't. But still, it's going to scare a lot of people off, and it really will have a negative impact on the foreign investment market. And lastly, this amendment was only announced very recently, so we are expecting to have some further clarification. There might even be some amendments, there might be some semi-backflips. We just don't know yet. We need to see what's going to happen. But we will keep you updated as more information comes to hand.